Ever feel like the world of money is a secret club with its own language? You hear words like bull market, liquidity, or short squeeze, and it sounds like a bunch of gibberish. You nod along, pretending you get it, but inside you're thinking, what in the world are they talking about? Well, consider this your official invitation. Today, we're busting down the doors to that secret club and translating their entire dictionary. We're going to take every single piece of financial jargon and turn it into something so simple, so vivid, you'll never forget it. By the end of this, you won't just know the words, you'll understand the game. And that understanding is the first step to winning. Let's dive in. Part 1, your financial scorecard. Let's start with the basics. Think of your financial life like a video game. To know if you're winning, you have to look at your scorecard. It's anything that can help you win or build wealth. This includes your house, your car, your cash in the bank, stocks, bonds, even that fancy watch you own. If it can be turned into money, it's an asset. Liability, these are the monsters you owe. They're the things holding you back. Your student loans, your credit card debt, your mortgage, anything you have to pay back. If it's a financial obligation, it's a liability. Net worth, this is your final score. It's a simple equation, assets plus liabilities equals net worth. If you have more assets than liabilities, you're winning. But if your liabilities are bigger, your net worth is negative. Don't worry, a lot of people start here. The goal is just to make this number grow every single year. Income, this is the stream of gold coins flowing into your life. It's the money you earn from your job, your side hustle, or your investments. Expense, these are the coins leaving your pocket. Your rent, your groceries, that coffee you buy every morning. It's any money you spend on stuff or services. Capital, it's just another word for money or assets you use to make more money. Think of it as the starting funds for your next big adventure. Amortization, this is the slow and steady march to victory. When you take out a loan for a house or a car, you're not paying it all at once. You're making a bunch of smaller payments over time. Each one is part principal, paying back the loan, and part interest, the fee for borrowing. That process is called amortization. Profit margin, let's say you sell lemonade. You spend $20 on lemons and sugar. You sell all your lemonade for $50. Your profit is $30. Your profit margin is how much of that $50 you get to keep. In this case, it's 60%. It shows how efficient a business is at making money. Part 2, the stock market playground. Now we are moving to the main event. The stock market is where the big money moves, and it has its own slang. Imagine a giant pizza. When you buy a stock, you're buying a tiny slice of that pizza, which represents a piece of a company. You now own part of that company, no matter how small. Shareholder, that's what you're called when you own that slice of pizza. You're a shareholder, a part owner. Ticker symbol. Every pizza shop on this block has a tiny short sign to identify it. That's a ticker symbol. Apple's is AAPL, Tesla's is TSLA. It's just a quick and easy way to find a stock. Stock exchange. This is the huge food court where all the pizza buying and selling happens. The New York Stock Exchange and the Nasdaq are the biggest in the US. Public company. For a company's pizza to be sold in the big food court, it has to be a public company. This means anyone can buy a piece of it. IPO, initial public offering. This is a company's grand debut. It's when a private company decides to go public and sell its very first slices of pizza to the general public. Volume, this is a popularity contest. It tells you how many slices of a certain pizza are being bought and sold. If a stock has high volume, it's a party, lots of action. Low volume means it's a ghost town. Dividends, some companies are so successful they'll give you a small cut of their profits just for being a shareholder. Think of platforms like Robinhood or Fidelity. Bid and ask, every trade has a buyer and a seller. The bid is the highest price a buyer is willing to pay. The ask is the lowest price a seller is willing to accept. The gap between them is the bid-ask spread. Tanking and to the moon. When a stock is dropping hard and fast, it's tanking. When it's about to explode upwards in price, people say it's going to the moon. Part 3. The market's personality. The market isn't just numbers, it has a personality, and sometimes that personality is a bit moody. Imagine a charging bull. It swings its horns up. That's a bull market when prices are rising and everyone is feeling optimistic. Now imagine a bear swatting its paws down. That's a bear market when prices are falling and the mood is pessimistic. Volatility, think of a roller coaster. Volatility is how much the prices jump up and down. High volatility means it's a wild ride, more risk, but also more chance to make or lose money. FOMO buying and panic selling, these are two of the biggest mistakes people make. FOMO buying is when you see a stock shooting up and you buy it just because you're scared of missing out, even if you don't know why it's going up. Panic selling is the opposite. You see a stock dropping fast and you sell out of fear, often taking a huge loss. These are driven by emotion, not logic, and they can be dangerous. Bubble. This is when a stock's price, or even an entire market, rises so fast and so high that it has nothing to do with its real value. It's just people buying in because everyone else is. When it bursts, the price tanks and a lot of people get hurt. Part 4. Your investment arsenal. You don't have to pick individual stocks to invest. There are tons of other options out there. Portfolio. This is your entire collection of investments. Your portfolio is your basket of stocks, bonds, real estate, and everything else you own. Blue chip stocks. These are like the trusted, classic cars of the stock market. They're well-known, reliable companies like Coca-Cola or Microsoft. They're generally safer, more stable, and less likely to cause a surprise. Mutual fund. Imagine a giant box of investments managed by a professional. You and thousands of other people throw your money into this box, and the manager buys a mix of stocks, bonds, and other assets. That's a mutual fund. Index fund. This is like a robot manager. An index fund doesn't try to beat the market. It just follows a market index, like the S&P 500, which holds the 500 biggest companies in the US. It's a simple, low-cost way to invest in a broad range of companies without doing any of the work. ETF exchange-traded fund. This is like a mutual fund you can buy and sell like a single stock. It's a basket of different investments bundled into one. A bond is like a loan you give to a company or the government. They promise to pay you back with interest over time. It's generally considered less risky than a stock. Commodity. This is an investment in a basic raw material like gold, silver, oil, or wheat. Instead of investing in a company, you're investing in the stuff they use to make things. An IRA, individual retirement account, is a special account where you put money to grow, and you can only take it out when you retire, often with major tax benefits. Part 5. Investment strategies and the rulebook. Once you know the basics, you can start picking a style of play. Value investing. This is like finding hidden gems at a flea market. You're looking for companies that are currently undervalued by the market. The idea is to buy low and be patient, waiting for the market to realize its mistake and for the price to go up. Growth investing. This is about betting on the next big thing. You're looking for companies that are expected to grow super fast. These stocks might be expensive now, but you believe they'll be worth a lot more later. Dollar cost averaging. This is the easiest and smartest strategy for most people. Instead of trying to time the market, you just invest a fixed amount of money at regular intervals, say $100 every month. You buy when the price is high and when it's low, which reduces your risk over time. Fundamental analysis versus technical analysis. These are two ways to research stocks. Fundamental analysis is like being a detective. You study a company's financial health, its profits, its leadership, and its business model. You're looking at the why behind the company. Technical analysis is like being a cartographer. You ignore the company's business and just look at the stock charts and patterns to predict where the price might go next. Holding company. a company that doesn't actually make or sell anything. It just owns other companies. Think of a giant's hand holding a bunch of smaller toy cars. Berkshire Hathaway is a perfect example. Part 6. The Wild West of Investing and How to Stay Safe. This is where things get a little risky, so pay attention. Leverage is using borrowed money to invest. If your investment goes up, your profits are huge. If it goes down, your losses are just as big. Shorting, this is betting against a stock. You borrow shares, sell them, and hope the price tanks. Then you buy the shares back at the lower price, return them, and pocket the difference. It's a high-risk, high-reward strategy. Short squeeze, this is a short seller's nightmare. Too many people are shorting a stock, and suddenly, the price starts to rise. Now all the short sellers are forced to buy the stock back to cut their losses, which pushes the price even higher. Stop-loss order. This is your personal safety net. You set a price, and if the stock falls to that number, your order automatically sells it. It's a way to limit your losses. Hedging, this is like buying insurance for your investments. If you own stock in a company that depends on low oil prices, you might also invest in oil futures. If oil prices go up and your stock tanks, your oil investment might go up, canceling out some of the loss. You're protecting yourself from risk. Pump and dump, this is a scam. A group of people buys up a cheap stock, starts hyping it up on social media, and then, when the price rises, they sell everything all at once, leaving everyone else with a worthless stock. Rug pull, this is even worse. Mostly in crypto, the creators of a project hype it up, people invest their money, and then the creators just disappear with all of it. The project is literally pulled out from under you. Dead cat bounce, when a stock crashes and then briefly goes up before falling again. It's a fake recovery. The term comes from the idea that even a dead cat will bounce if you drop it from high enough. Whales, these are the big fish in the ocean. The whales are huge investors or institutions that can move the price of a stock just by the sheer size of their trades. When a whale moves, everyone pays attention. You now know the vocabulary, but what does it all mean? Every single one of these terms is just a piece of a larger story. The story of money, of value, and of human behavior. You now have the power to understand the financial news, to see through the hype, and to make smart decisions for yourself. Remember, inflation means the value of your money is slowly eroding. ROI tells you how well your investments are doing, and compound interest is your best friend. It's the magic that allows your money to earn money, which then earns even more money. You're not just a passenger on this journey anymore. You are now the pilot, and you have the entire control panel right in front of you. So, what's the first term you're going to look up now that you know the language? Drop it in the comments below.